Welcome to a special holiday edition of Bloomberg Daybreak. U.S. markets are closed for President's Day. I'm Nathan Hager. And coming up on today's program, what's ahead for earnings from the world's #1 big box retailer? Plus, how to prepare for a second Trump presidency. Why the obvious market bets might not be the right ones. And we speak to a big name in architecture and design. Hear his take on getting workers back to the office. That's all straight ahead on this show. First, let's begin with a conversation on earnings from Walmart. The company's due out with fourth quarter results on Tuesday. Here for a preview is Bloomberg Intelligence senior analyst Jennifer Bartashis, who keeps an eye on all things retail for us. Jen, great to have you with us on the holiday. So this is a holiday quarter for Walmart. Shall we say it's going to be happy returns?
In general, I think it was a very strong holiday season for Walmart. When consumers are nervous, that plays directly into Walmart's strength. And when we look at what we observed in the stores, we saw a lot of customer engagement with Walmart during the entire quarter, from Black Friday all the way through. And so there's every reason to think that they should have a pretty good quarter.
Are we going to see the kind of markdowns around the holidays that could eat into margins?
Well, actually, I think that Walmart has done a very good job of changing the way they plan for holiday and being much more measured with regards to inventory. When we really run into problems with markdowns, it's when there's just too much inventory and they're not able to sell through it. In our channel checks, when we've been in stores, we actually didn't see a very high level of markdowns, which is very, very promising. And that means that they really probably sold through the majority of their holiday inventory according to plan. So that should have very little impact on gross margin, at least for this quarter.
So what are we thinking that we're going to see in terms of the sales mix? When you think about a holiday quarter, you're thinking about a lot of big ticket gift items possibly. At the same time, Walmart has a lot of those staples that it sells throughout the year. I'm thinking about groceries and other lower cost items. So what are we thinking in terms of a sales mix around a holiday quarter?
Well, even for the holiday quarter, I think their sales mix still skews to the consumables. If you think about Thanksgiving fell in the quarter, that's a huge food holiday. We saw a traffic spike at Walmart as people were going in to buy ingredients for those celebrations. And they just sell so much food. But the good news is that, because inflation has been moderating a little bit, and because Walmart was really quite outspoken with regards to holding prices steady from last year, especially on holiday related foods. There may have been a little extra money in people's pockets to actually buy into the higher margin part of the store, which is general merchandise. And while we didn't expect to see a lot of big ticket sales, we do expect that they'll have done a little bit better on things like apparel, beauty items, things that are smaller level indulgences, but make good gifting items.
It would be interesting to see if we do get that kind of mix, because even though inflation is coming down, it is still at pretty elevated levels. So I wonder what you're thinking in terms of what we could see when it comes to consumers possibly trying to buy items that sort of protect them from inflation at a place like Walmart.
Well, with regards to inflation, we are seeing some disinflation in food, but it's not across every category. And so what we're continuing to see customers and consumers gravitate to value. And so, where they feel that they're getting a good value, Walmart has been pretty aggressive in rollbacks where they've seen inflation come down, and that generally attracts consumer attention. And so the disinflation we're seeing is more on the food side of the business at this point. And so we do see that as a positive, but it's still going to be a little bit of time before things really smooth out.
And of course, Walmart has a fair amount of competition in the food space, not just from its more traditional competitors, but even now from Amazon, which is, of course, a huge competitor for Walmart just across the board. Where do you see Walmart in terms of market share against some of those other really big competitors in the retail space?
Well, Walmart does have the lion's share of market share, especially in grocery. But there are never-ending threats with regards to competition in this space, because it's a very low-margin business, and because it is an area where everybody needs to buy food and basic essentials. There's just a lot of competition. Amazon has definitely been sending indications that it wants to step up its game, and that it wants to become even more kind of double down in grocery. There are some big pieces of that strategy that we need to understand a little bit better and how quickly that will materialize. Because Walmart's really big strength is that they have all their stores, right? It's easy for people to stop in. It's easy to do click and collect and place orders online and pick it up at the store. And then they also have their marketplace. And so for Amazon to compete effectively, they really need to solve that problem of how you compete with that many physical stores. And that'll take some time for Amazon to figure that out. On the general merchandise side, though, one of the other things that we're watching carefully is the rise of like Temu and Shein, and because these are direct competitors more on the marketplace side and more on the general merchandise side. So we are seeing a lot of competitive dynamics across the board for Walmart.
Bloomberg Intelligence senior analyst Jennifer Bartashis. Thanks for this, Jen. Really good having you on with us. And we'll be looking out for those earnings from Walmart. They are due out tomorrow around 7 a.m. Wall Street time. But before that, roughly an hour earlier, we expect results from Home Depot. And those details could give us a check on the housing and home improvement markets. So here to discuss those numbers before they come out is Drew Redding, who covers housing for Bloomberg Intelligence. Thanks for being here, Drew. Of course, we know just how challenged the housing market's been with high mortgage rates and high listing prices. How could that play into the results we get from Home Depot on Tuesday?
Sure. So heading into the results, the bar is pretty low for Home Depot. If you recall, during their last earnings release, they guided to same-store sales being down about 3 to 4% for the full year. So that's kind of what we're expecting to see in the fourth quarter as well. If you look at some of the data on retail sales, you'll see that when you look at home centers, the market's still declining in the low to mid-single digits. So it's still a challenging environment, but I think the attention has really started to shift to 2024. And on that note, we would expect that they're going to suggest probably a remodeling market that's relatively flat next year. And that would be similar to some of the commentary that we heard from some of their suppliers. So better trends in the second half versus first half, but still a little bit of a challenging market out there.
You wonder, well, whether that outlook for the second half could stay as resilient if we continue to see interest rates at the levels that we're at right now, and this expectation in the market that maybe the Fed's not going to be able to move as quickly as we might like. I mean, that could play into the outlook for Home Depot as well, couldn't it?
Yeah, that's a great point, because part of the reason that we think the second half will get better is because we're assuming in our base case that mortgage rates fall down to somewhere at 6.25%, 6.5% as we get through the year. And the idea is that would boost existing home sales. And as we know, people that move tend to spend significantly more than people that don't move. So to the extent that interest rates remain high, we have seen a lot of volatility. And with that hot CPI print we had recently, we actually see mortgage rates back above 7%. So to the extent that rates remain high and volatile, that could certainly impact existing home sales and ultimately demand for remodeling spending.
And to the point about home remodel spending, you got to wonder what the appetite is for big home projects right now that Home Depot caters to. With inflation where it is, I mean, how can you game that out?
Yeah, so we have seen a pullback in big ticket discretionary purchases. That's really been one of the drivers over the last couple of years that's really helped boost same store sales. And that's where we're seeing a pretty big pullback, declines in the mid-single digit range. We don't think these projects are necessarily being destroyed, but they're being delayed. So we do think that as existing home sales start to pick up and we get to the tail end of 2024 and into 2025, we do expect to see a rebound. And one of the reasons is because what we're seeing with home equity. Home prices are up more than 40% over the last couple of years, and homeowners are sitting on record home equity. On average, the average home owner has about $300,000 in equity. So we do think that big ticket market will start to unfreeze towards the tail end of next year and into 2025.
Yeah, that'll be an interesting point to see whether that home equity continues to keep the consumer going like we've seen. There's been so much resilience in consumer spending despite inflation. When it comes to this quarter, though, Drew, how much of a factor does seasonality play in? How do companies like Home Depot typically do in a holiday quarter?
Yeah, so when you think of Home Depot, traditionally their strong season is in the spring. That's where they make a lot of money. But that being said, Home Depot and Lowe's and the broader home improvement industry has really started to lean more into the holiday because they've seen a lot of demand from consumers. That includes Halloween, where they've had great success, great deals on Black Friday, and they've continued that into the Christmas holiday. You've seen them expand their assortments, and consumers have really reacted positively. So it's not an area where you would traditionally think of a home improvement retailer like Home Depot really leaning into, but it is something that they've got more involved in over the last couple of years.
Yeah, you can't help but notice the inflatables that time of year
Yeah.
that put out on the lawn. Now, I know you've done some research over at BI on the growth opportunity that Home Depot could get out of the professional contractor segment as opposed to DIY customers. Is that something that Home Depot's moving into more aggressively, and can we see that reflected in the results as well?
Yeah, great question. So in the near term, the professional contractor is still outperforming the DIY customer. But if we step back and we look big picture, Home Depot generates about 50% of their sales from that professional contractor. On the other hand, Lowe's generates about 25%. So that's been one of the key drivers of relative performance for Home Depot. But what's interesting is we kind of look down the road a little bit, they're tackling a new market for what they call complex pros. So these are bigger projects, think of large scale remodels and renovations. And what they're trying to do is really consolidate the number of suppliers a contractor needs to work with. So you think of a traditional contractor, maybe they're getting windows and doors from one supplier, they're getting flooring and cabinets from somewhere else. So what Home Depot is looking to do, and they've rolled this out in a couple markets, is consolidate that relationship. They want to bring everything in-house, and they're looking to be able to do this type of project in bulk. So it's something that represents a huge untapped market for them. It's probably something that's going to develop over the next several years. But as you mentioned, a big growth opportunity nonetheless.
Do you think that's the kind of thing that could play into the outlook for this year that we get from Home Depot this week?
So I don't know necessarily that it's going to move the needle in 2024. We do think that the pro will probably come back with greater strength towards the end of the year. But in terms of this kind of new initiative on those large complex projects, we think that's probably more of a 2025 into 2026 story.
Interesting. Well, we're going to be looking out for those results from Home Depot just around the corner here. So thanks for this, Drew. Really good having you on with us.
Thank you.
And that's Bloomberg Intelligence Senior Analyst Drew Redding. Up next on the program, how to prepare for a second Trump presidency. John Authers joins us with his opinion, including why the obvious market bets might not be the right ones. That's straight ahead on this special holiday edition of Bloomberg Daybreak. I'm Nathan Hager, and this is Bloomberg. You're listening to a special holiday edition of Bloomberg Daybreak. U.S. markets are closed for President's Day. I'm Nathan Hager. And as we get closer to the next presidential election, the question that many investors are asking themselves more and more is this: how should I position for a second Trump presidency? To try to answer that question, we bring in Bloomberg opinion columnist John Authers, who writes on markets and investment. Great to have you on with us, John. And while none of this is a foregone conclusion, we did see how caught off guard markets were after Trump won in 2016. Are we in a better position this time around? I mean, we kind of know what we're going to get from a Trump presidency in some respects.
In some respects. I mean, I think the big difference is that absolutely everybody knows that it could happen, whereas 8 years ago, most people didn't think that. The other interesting thing about last time around, though, was that the actual impact of how Trump would affect markets was very difficult to gauge. So you had the last few months before the election, every time something looked good for Trump, the markets would sell off. And then when he actually surprisingly won, the markets had a great boom. So that in itself makes it very hard to track what he's going to do. I think what is intriguing at the moment, and I'll try to stay in my lane as a financial rather than a political pundit, but the belief is very strong, even among relatively more conservative outlets, that Trump 2.0 is going to be different, that he's really going to do populism properly this time, that he's going to be genuinely authoritarian, that he's going to do protectionism properly this time, and that he's really going to leave NATO, etc., etc. That is interesting how strong that point of view has become and how quickly it took shape at about the point that Ron DeSantis was plainly blown it towards the end of last year. It really became very clear that it was going to be a Trump candidacy again. It's interesting how that suddenly became something approaching a media panic. And it's hard to imagine that won't also have had an effect on the market. So we're dealing with what is with something that people can understand and can accept as a possible outcome, which is different from 8 years ago. But I'm not sure that the level of certainty about exactly what he would mean is there. I mean, in terms of his economics, 8 years ago, Trump's first term was basically straightforward Chamber of Commerce, traditional conservative Republican economics, tax cuts, lower regulation, nothing that would particularly scare the markets. Whereas some of the stuff that's being talked about this time, if he really does try for something more genuinely economically populist, wouldn't necessarily be so popular in the markets.
Yeah, and some of the things that have been talked about, to your point, have already started to raise some eyebrows. This idea of a 60% tariff on Chinese imports and elevated tariffs across the board for other markets. I mean, how do you prepare for something like that? Is that something that investors really do need to keep in mind in the event that the election does go Trump's way?
I think you can tell that investors do have that in mind because of what's been happening to Chinese stocks, which there are many good reasons to be relatively negative about China these days. The fact that depending on which index you're using, Chinese stocks are worth no more than they were 20 years ago. When you think of the growth that's happened in China's economy in that period, plainly that would make no sense at all unless people were trying to factor in some fairly considerable risk of major protectionism. Ultimately, I think the way that benefits, if there is somebody to go long on, and obviously you want to be short on things directly affected with China at the moment, there is very unobtrusively there is a big boom in Mexico, which is extremely counterintuitive given that Trump's first policy pronouncement when he first, immediately after coming down that escalator in 2015 was to attack Mexico. Mexico is probably the single biggest beneficiary of a really big tariff on China because it has much more of a chance to get to get jobs back on its side of the border, and it would behove the US to make it easier to build jobs and factories at the border, because that way people are more likely to emigrate from Central America and stay there rather than try to cross the border.
What could it mean for the dollar, the bond market, if the former president does become president, succeeds in doing populism, as you say, right this time?
I think if he does populism right, and again, politically, there are lots of things wrong with the way the American and Western European economies have gone over the last few decades. So it's a perfectly defensible policy choice to make. I think it's pretty straightforward that markets wouldn't like it. However, on the issue of tariffs, if he's really going to go with big protectionism, that's bad for the dollar, because the foreign exchange market will generally try to counteract tariffs. So if you're making imports that much less competitive through adding on tariffs, the currency market will generally make them more competitive again by changing the exchange rates. I think the very interesting subject that may yet come up, and which is a much more valid subject than any other, is fiscal policy. If Trump is at the moment, there's in terms of neither Biden nor Trump has any real moral right to complain about the scale of the deficit at the moment, because they both started their terms with by taking actions that quite obviously increase the deficit, a huge unfunded tax cut, and then all the spending that Biden did at the beginning of his term. Mm-hmm. There does come a point, and when rates are higher, that point is closer, when you really can't finance too much more borrowing, or you can, but it just has to be at higher rates. That is one that I think there is certainly a chance if you get a Trump 2.0 and he starts with a tax cut and a tariff and spends some money on something, or boosts defense spending, something like that, it's possible that you really do get a bond market strike, that the bond yields shoot up.
And to your point, John, one of the big legislative victories that Trump 1.0 had was a massive tax cut, as you allude to. It raises the question about whether the Fed steps in to sort of counterbalance whatever might happen on the fiscal side. And even during the first go-round for former President Trump, we saw him really hit the Fed hard, at least rhetorically, on social media.
Yes.
What's the potential impact on Fed independence of a second Trump presidency?
That's a very interesting one. I certainly get the impression, but again, we need to see how the difference between bark and bite. He did appoint Jay Powell, who at the point that he hired him had been a Fed governor for I think as long as 10 years. Had certainly been around for a long time. He had never dissented from any of the monetary policy decisions they had made in the years before. He could have, there were a couple of plausible candidates, Kevin Walsh, John Taylor. There were some candidates who would have very clearly really shaken the Fed up. And instead he really moved. It's difficult to see anything that Jay Powell has done that you can confidently say Janet Yellen wouldn't have done. Mm-hmm. So let's get that clear at first. It's one of the things that happened in Trump 1.0 was that he blinked on the possibility of really shaking up the Fed.
Yeah.
And in terms of the institutions, the Senate balked at one or two of the obviously unqualified people he wanted to put on the board. Now, if you have, and I think if he does win, the chances that he has the Senate are very high. Mm-hmm. If he has a majority in the Senate, and that majority has moved more in the MAGA direction and further away from the Chamber of Commerce institutional Republican wing, it's possible he could really do some things to the Fed's he could effectively change the Fed's independence by bringing on some much more radically minded people. That is a possibility. Again, I'm not going to tell you that the Fed has done a perfect job in every respect, and is above criticism, because that's obviously not true. Again, from the point of view of how markets would deal with it, they like the devil they know, and that would scare them. They are much happier with monetary policy being, at least to some extent, free from democracy, free from the travails of being buffeted by democracy. So that is the Fed could become a very interesting question. I mean, for his first year, I don't know of a way. I mean, we now have an impeachment of Secretary Mayorkas. I mean, unless they want to impeach Jay Powell or something, which I can't imagine would get 2/3 in the Senate.
Yeah,
I'm not, as far as I'm aware, he can't fire Powell until his term ends a year into the next presidential term. Mm-hmm. Generally speaking, if the Fed thinks fiscal policy is too stimulative and may tend to make inflation worse, it's just straightforwardly in their mandate, okay, they'd better tighten monetary policy accordingly. they're not allowed to sort of get into a political flame fight about whether it was sensible to be spending more money, but they are allowed to say we see this as increasing the risks of overheating and inflation, so we're raising rates. That's very central to their traditional punch bowl role.
It's a lot to think about as we get closer to finding out what version of the next presidency we're going to get.
Exactly.
That's Bloomberg opinion columnist John Authers. And up next on the program, we talk return to office. Stay with us for a conversation with a big name in architecture and design for his take on getting workers back in the building. That's straight ahead on this special holiday edition of Bloomberg Daybreak. I'm Nathan Hager, and this is Bloomberg. Welcome back to this special holiday edition of Bloomberg Daybreak. U.S. markets are closed for President's Day. I'm Nathan Hager. Now let's bring you a conversation with a man who wants to change the face of our cities. Thomas Heatherwick is the designer behind New York's Little Island and Vessel in Manhattan's Hudson Yard District, as well as Google's new London headquarters. He says our buildings need to be more human and less boring. Heatherwick has said Vessel will reopen to the public this year after being closed in 2021 for safety reasons. He's been speaking with Bloomberg Daybreak Europe anchor Stephen Carroll. Stephen.
Nathan, Thomas Heatherwick is one of the best-known names in modern building design. His studio has won more than 100 awards. Cities from New York to London to Tokyo boast examples of his work, and he even designed the cauldron for the Olympic flame in the 2012 London Games. Now he wants to end what he's called a blandemic in buildings. He's written a book on the subject called Humanize. I've been discussing this with him and how he's applying this philosophy to his latest projects.
We talk about how nature is good, and there is evidence showing that people take less time to heal in spaces where they can look out at nature. And what nature has is a necessary visual complexity. And we've had buildings for the last 80 years which are flatter and smoother and shinier and plainer and more serious than ever in history. And what the science is starting to show is that they aren't just maybe not nice, some people might call them ugly, but they actually, your body starts to go into stress when you don't have necessary visual complexity. But I'm not calling to go back to the past and copy old buildings. Even some of the new buildings, they've really made an effort to put visual enrichment and detail into them, which makes it interesting to walk around. But it's not just a cosmetic thing. What we've discovered is our humanness needs places to have that interestingness.
That's a difficult conversation, though, when you're thinking about where the money goes in a project. What value should we be placing on design when it comes to a building like that versus the cost?
Value's the word. That value really is the right word. The problem we had was that style that came in that said flatter, smoother, shinier, more serious, plainer was fashionably good, was not good for us, but it was also a bit cheaper. And so with the Humanize campaign, we're really arguing that we need to make a step change, a bit like we've had in the world of architecture. We talk about the green premium, which is that a building, you do need to pay a little bit more for it to be highly environmentally good, performing well. But unless people care about it, we've had this dirty secret in construction, which is buildings get demolished. And so the worst value is to build buildings that society doesn't care about because they get demolished. So, for example, with commercial buildings, the average age in the UK of a commercial building is 40 years. So if I was a commercial building, I would have been killed 13 years ago. And the carbon in construction is 5 times that of the whole aviation industry. So they're bad environmentally, they're bad socially, because they don't bring us together.
Yeah.
And after COVID, when the digital revolution has really kicked in, you can stay at home, get a PhD, work, buy everything. Cities are dangerous places when you don't have people in them. So we need cities that bring us together and nurture the togetherness and not being scared of each other.
Does that need to go into planning rules then? Is this a question that we need to change the regulations around buildings in the same way that we do around sustainability to incorporate rules like that?
Planning's been quite basic, and it's a very difficult thing to get right. But in the book, we talk about the 3 distances you can experience buildings. If you imagine being 150 metres away from a building, seeing it from a distance, how it fits in with the city, you then look at the street distance, which is when you're starting to be maybe only 20 or 30 metres away. But the most impactful, and the one that we've found the least regulatory support for design teams, for society, is door distance. Because actually your emotion isn't at the top, it's at the bottom, because that's where we all are, where us as passers-by walk past. And we spend too much time talking about insides of buildings. 1,000 times more people will walk past the outside than ever go inside. So designing for buildings to be givers rather than takers. I mean, selfishly, as a designer of buildings, I want your great-grandchildren to say about one of the buildings I've done, no, don't knock it down. Let's repair it. Let's adjust it. Instead of saying, meh, knock it down, because the carbon in buildings it's ridiculous.
On the projects that you've worked on, like for example the Google campus at King's Cross, which people might be very familiar with in London as well, there's a fantastic roof garden going onto the top of that, which is, you know, a really interesting design feature. But again, that's when you talk about perspective, that's not at the street level. Whereas when you walk by at street level, from the images that we've seen, does it look that different from what else that you see in the area? How does it? How would you contribute to resolving that issue?
Well, I'm actually really pleased you've brought it up, because you don't know what we're doing at the ground level. It is an enormous building. It's 330 metres long. It's the same size as a cruise liner coming into King's Cross. So, as you will see, and what isn't apparent at the moment behind the hoardings, and the amazing thing about the building is it's lifted up 2 stories. And so underneath, we can build a village. So that village will start to be being constructed this year. And that will be a higgledy-piggledy collection of wooden sub-buildings of differing heights. They tip forward at different angles. They're not in alignment. They're different colours. They have different people and community organisations as part of them. So in a sense, we're going to be doing a radical chance to reinvent High Street. But to my point, we judge buildings all the time by the top, just as you have. The ground is actually where your feeling is. As you say, no one's in a helicopter looking down on the amazing garden we've put on the top.
And it's only the lucky people who work there that get to use it.
Yeah, and it's wonderful. I mean, we're in an incredible building at this moment. You're one of the privileged people in London who will get to be in this building, as will the people in our Google building. But your real duty, I believe, as a building designer, you're to some extent a public servant. And so what are you making a building give? But I don't think this is sort of just altruistic. It means that for a Google, an organisation like that, what does your employee think as they walk into that building, as they tell their grandmother they work there? How do the social values of that building manifest? And for a very long time, we've had buildings that have been takers, not givers. You know, how many times have you walked down a street past a big glass lobby, dead to the passerby, and you can see there's some luxury private world beyond, and you can see the leather sofa and the marble reception desk, but it's got nothing for you. It's almost rubbing in its exclusiveness. So the Google building in King's Cross will be the opposite of that.
Okay. I want to ask you about your journey on coming to these conclusions in this latest book as well, because, you know, you've had these huge triumphs. We've talked about some of them already. One project which has attracted criticism was Vessel in New York. It had to be closed to the public since 2021 over a number of suicides that happened there. I wonder how you feel about that project now and how you reflect on what you learned from that process.
Vessel was a project commissioned to help create the atmosphere and identity of a new district in New York that hadn't existed before. It was a very, very brave piece of commissioning and an incredible investment in helping to wholeheartedly make distinctiveness in a place. But it timed, very unfortunately, it timed its opening just before this terrible pandemic, something that affected the mental health of the millions of people all over the world. And some of that mental health impact was particularly felt amongst young people. That project was astonishingly compelling in how it engaged people. It was a #1 backdrop on Grindr and in Tinder and all these things. And the project was built above code. The barriers all around it were built above the code that would have been needed for any normal structure. But its compellingness had a dark side. And so there were no accidents on it. It was very sadly chosen by a tiny handful of people to do this terrible, awful thing. So this year is the year that it's going to be refitted with a protective barrier. But it was this sort of dark side of its success was this use that people had. I mean, nearby there are levels that are just as high as many bits of the vessel, which have balustrades that no one was choosing to jump from. So it was a very sad and telling thing of our time. It will be later this year that these safety measures are going to be implemented by the commissioners of the project. So I'm pleased to be able to say that.
Do they diminish your design in any way, do you think, to have protective screens like that erected onto the
No,
piece?
because we've worked with them and they've been really sensitive to getting the design to have the similar quality as the original vessel structure. So it's not a kind of thing thrown on at the last minute. It's had an enormous amount of development and reflection to get it right. So my hope is that it will, and there at the moment there is a sample section of it on the vessel, and it looks really good. Okay. So it doesn't need to be at the cost of the project. The whole point of the project is it's public. My passion, all my studio's projects are public. And look at Little Island. If you go, just down from there, that opened 3 years ago and is just packed with people and loved, and has these free performances on it, and is a main place for New Yorkers' fitness and visitors, and is all about the river and nature. So I think we are hungry for public spaces that are wholehearted and which sort of validate all of us. The thing that sort of inspires me really is that there are 7 point whatever billion people on the planet, and every one of us thinks we're special. Yeah. It's human nature. And I think for too long we have not designed the places, the public life. You know how they say you can't change what you can't measure? We haven't been measuring the biggest experiences of buildings who are on the street outside, who will never come in.
That's Thomas Heatherwick, the founder and design director of Heatherwick Studios. And he's not daunted by the prospect of higher interest rates or remote working threatening the future of offices. He says he's hopeful and excited by the challenge of adapting existing buildings to new uses. And that's a question, he says, of being ingenious with what you've got. Nathan?
Thanks, Stephen. That's Bloomberg's Stephen Carroll from our European headquarters in London. And that does it for this special holiday edition of Bloomberg Daybreak. Join us again Tuesday morning at 5 a.m. Wall Street time for the latest on markets overseas and all the news you need to start your day. I'm Nathan Hager. Stay with us. The top stories and global business headlines are coming up right now.